So we not going to focus too much, hopefully, on just Wirex itself, rather more on the industry trends in general and what's possible, what's not possible in payments. Yeah, sure. Okay. And yeah, I didn't realize there would be another talk just before this one about stablecoins, so we should have probably just had a panel together, and it just shows how hot the topic is getting. Anyway, once again, I'm Georgy, one of the co-founders at Wirex. Let's start with a quick reminder of why we're here, not here necessarily just in Belgrade, but in this industry. And we probably need less of a reminder at an Ethereum conference, because a lot of people are actually focused on building. It would be a different case at a Pump.Fund conference, where it's less about the real life use cases and building and more about various kinds of speculation. But yeah, basically, the whole idea of cryptocurrency back in the day started with the premise of people being able to pay each other in a trustless manner. And sometimes in this industry we deviate from this original vision. But now I think is the time when it's finally coming to fruition in more in real world and at certain scale. So what's the vision? Why it is cool? The payments on-chain payments can be instant, cheap. They allow for a lot of things to happen in a different way from traditional finance, and they've got quite some disruptive potential. Yet we don't see mass adoption yet, and we may want to look and think into why. It has been a bumpy road, and the previous talk dived deeper into the history, into the details, so we won't focus too much on that probably. Mainly, crypto has been used for speculative use cases rather than anything else. So originally, stablecoins in particular were used for hedging, and other cryptos mainly for speculation and just to gain. Hype has always been ahead of tech in most cases, and in the context of stablecoins specifically, there was a lot of controversy. So there were DPEGs, there were complete failures, there were questions around viability and sufficient reserves, which kind of changed. In my view, the moment when it changed, it was a combination of improving technology, improving tech, so blockchains themselves getting faster and transactions becoming cheaper, and the end of the zero interest rates environment, until which point stablecoins, they did have a use case, they did have a product market fit, but they didn't have a viable business model. But when interest rates started going up, a few years later, everyone stopped asking questions, oh, is Tether actually backed up or not, because they started making so much money that the question became irrelevant. So that was a kind of perfect timing, perfect combination. And last not least, we've been in this space for 10 years now, and although Wirex started originally with the idea of you should be able to buy your coffee with Bitcoin, because Bitcoin is a currency, if we read the original white paper, but what we realize is people don't buy coffee with Bitcoin. So on the one hand, one of the fundamental features of a currency is being a means of exchange. So if you can't buy goods and services, then one of the three main features is missing. And that means it's not money. But in case of Bitcoin, the narrative has really changed. It's more become a kind of a digital gold narrative rather than a payment instrument. And that payment use case is mostly being taken over and has been taken over by stablecoins. So let's look at the most recent developments. So over the last 1-2 years, most major payment institutions started actively looking into it. I think the kind of awakening moment was Stripe buying Bridge. A 2-year-old company got acquired for over $1 billion, and everyone started talking about stablecoins because people suddenly realized that it's not just USDT or whatever that crypto traders used out there to hedge their positions or just to move funds between exchanges, that actually players like Starlink and other major companies are using them to accept payments in different parts of the world. Visa and MasterCard themselves have big crypto divisions and specifically people and projects focused on stablecoins. And looking back when, for example, in the case of Wirex, when we were starting, when we issued our first, I can't even remember whether it was Visa or MasterCard back in 2015, but the key message is that it of course wasn't a direct relationship with Visa and MasterCard. They wouldn't even let you through the door. It was impossible to even have a chat, and even through one or two intermediaries, that was the kind of architecture we were using. So you couldn't issue yourselves directly because we were not yet a licensed company. But even talking through an intermediary who served as a card issuer for us, when we knew that, when they told us that, oh guys, this week Visa is going to review your application for the co-branded card program, so you know what to do, and we knew what to do. We removed every mention of Bitcoin from the website. It was that bad. So, and now not only we're direct principal member of both Visa and MasterCard, not only Visa and MasterCard have their own head of crypto division, each one of them, they bet big time on cryptocurrency and stablecoin technology in particular. Already mentioned the technological advancements, so Ethereum got faster, L2s came up, Solana and other networks became a lot more usable in the real world, and all that caused adoption and use cases. And this is the number, nearly like over 25 trillion transacted in 2024 in stablecoins. That's not data from June or even CoinMarketCap. That's the data from Visa own website, which shows that stablecoin transaction volume exceeded volume of transactions on Visa or MasterCard networks. So that's quite a fundamental change in what's happening. And then we see a lot of crypto companies becoming public companies, and the likes of Coinbase, Circle, Paxos, BitGo considering getting banking charters. That's quite an achievement, quite a long way since we started in this industry. What can be the possible use cases? I think the biggest one is cross-border transactions, because that's where the most frictions exist, and that's where SWIFT still takes 5 days and can cost up to $50 to send $5. Not sustainable, not really workable. B2B payments and treasury management as well, especially after this news about Bridge came out. A lot of people realized that traditional companies are already using crypto to manage their treasuries and do payments with suppliers and customers. Payroll and contractor payments. A lot of people in this industry work remotely. A lot of people in this industry get paid in stable coins. But even outside of that, the world keeps globalizing remote work, although that trend has been a little bit on the decline recently after COVID, but still a lot of people work from different places, and especially if it's a small and medium business, pay 50 different people in 20 different countries in different currencies is a pain. Stablecoins can fix this. And then less obvious but also important cases, just e-commerce and retail payments. It contributes to inclusion. These payments are a lot more transparent. When you send a SWIFT for 3, 4, 5 days, you don't know where the money is. There's a good example. There's a company called Mighty here, and we just met last year, and I can't show Mighty enough. It's a great business, a great help. So we ended up partnering, and we needed to make a payment. And we are a UK-based company, and they are a Serbian-based business. So quite naturally, we send them a bank payment via the bank that we use, via SWIFT. 2 weeks later, I'm getting a question from Artyom, the CEO. We haven't received the money. Can you possibly check? So we go to our bank. We find this proof of payment. We send it to them. They take it to their bank. Their bank realizes they didn't receive it. They didn't activate the bank details. Long story short, a month later, they haven't found the money. So eventually, they sent the money back. We finally traced it that, yes, we received it. We tried it again 10 days ago. The money is still not there. So it's probably a bit of an outlier example, but it still shows how inefficient the whole system is and how how many movements you need to make to even just trace it, and still even then you cannot really know where the funds are. They are somewhere stuck in between one or another intermediary bank, whereas on a blockchain you could see it there. Not only it will probably arrive before you even start checking, but if it ever got lost you could easily find it. So transparency is and auditability are great features as well that we may not necessarily always think about. And yet how many people here are using stablecoins or any other cryptocurrencies in their daily life and payments? Anyone? 1, 2, 3? Well, that's a very, very savvy audience, but still, by far not everyone. And as soon as we walk out of the Sava Center and check with the local coffee shop, they probably won't have heard about it. So what's in the way? It's still relatively complex. UI, UX is, we working in this industry, living in this increasing in size, but still a bubble. We think it's all out there, but it's still very difficult for an average Joe. Transaction fees can still be high. It's very easy to send stablecoins cross-border, and you don't even think about it as cross-border because it all happens somewhere there in the cloud, right? It doesn't matter whether it's from Serbia to Montenegro or whether it's sent from Australia to Canada, right? But this first and last mile is still not ideal. You need to get those stable coins or other crypto and then get out of it to be able to transact in the real world. And there are still some friction points there. From regulatory perspective, it's still quite uncertain. In some countries, there's existing legislation. In some countries, it's in the process of forming. Us being a regulated business, it's a double-edged sword. On the one hand, it adds credibility. It enables more people to start using it. On the other hand, it's a constant pain, and it's usually quite a one-way abusive relationship with regulators. But we know that's the price to pay for this to go mainstream. But we do need more clarity. Is it legal? Is it not legal? Is it gray, white, or completely black in some countries? And trust concerns is an important one as well, especially after the events in the industry a few years ago. There's more and more movement towards self-custody because trust in centralized financial institutions has not been growing. And if we look at balances on centralized exchanges, despite the activity relatively high at the moment and the we're arguably still in a bull run and probably some way to go, but balances on centralized exchanges have been going down. So what do we need to finally bridge that gap with the technology already being there, with everything being there, but still no mass adoption? This new means of payment, money transfer, whatever we call it, needs to be seamlessly integrated into existing financial system, not just be stand alone separately from it. Transactions need to become even faster and gasless because when you make a payment for your coffee, you don't want to worry about paying an additional gas fee. That would be, I mean, we would probably accept it in this audience, but for an average person, why would they if they can do without? Again, this is adding on to the point about seamless integration into existing systems, there need to be familiar tools that allow people to spend stablecoins or to use stablecoins without having to learn too much. We kind of adopted this concept back in 2015 by issuing the first card that allowed people to spend Bitcoin. It wasn't a crypto card or a stablecoin card, it was a Bitcoin card because neither stablecoins nor Ethereum nor EVM did exist yet. But still, when you give a customer something they're already familiar with and add a little bit of new technology on top, that's more easy to digest rather than jump into something completely new. Self-custody and regulatory compliance, they go kind of hand in hand. It's the less, so if you don't take, as a business, if you don't take the user funds into custody, same way if some people don't understand that actually, so let me maybe paraphrase. So historically, to be able to spend your crypto with most card providers, you needed to deposit your cryptocurrency or stablecoins with them. So same way as you bring your euros or dinars to a bank and give the bank your money, and then you're able to spend it. Historically, that's what you needed to do to be able to spend your crypto in the real world. And that setup requires, it automatically makes you a regulated financial institution because you're taking people's money. There's a way now, with the technology developing and with layer 2s and some layer 1s becoming a lot faster, to enable seamless on-chain transactions without the payment provider ever taking custody of the user funds. And that's A, safer for the user, and B, that can keep the payment provider outside of the regulatory scope to a degree. And yeah, basically, it needs UI, UX, and global infrastructure that people are actually happy to use, because people don't like change, and especially when it comes to a relatively conservative matter like money is. No one wants to play with their money that much, except pump.fund users, of course. So what we've been building for quite a while, and what's changed relatively recently. So Wirex has been in this space, and a few other companies for quite a while. So the first crypto cards started popping up about 10 years ago. By now, some of those companies are direct members, like actual issuers, whereas before that wasn't the case. Visa and MasterCard were not willing to work directly with crypto companies. Now they finally are. On the self-custodial side, the account abstraction technology became quite a big enabler. So the way it works now, you can actually tap your card, and an on-chain transaction happens, and the funds go directly from the user's wallet into Visa MasterCard network, and the merchant receives their final currency. ZK technology enables these transactions to be fast, private, and secure. So in the case of this particular self-custodial card, it's funds need to be on a Polygon ZK rollup because it's fast enough for those transactions to happen. In some cases, for other providers like Gnosis Pay, for example, they enable this on their own Gnosis chain. In our case, we're trying to be chain agnostic, not to force anyone to use any specific chain. There are some other card providers like Argent Wallet, for example. They use it on Starkware. So hopefully this will merge better, and there won't be a need for users to keep in mind and remember, oh, which chain do I actually need to bridge my assets to. We're hoping this will also become more streamlined. And in our case, unlike quite a few similar companies, we're not pushing you to use any specific chain. We want to be chain agnostic and deploying on base as we speak, and we'll add more chains. Transactions need to be gasless because the user doesn't have to worry about it. Otherwise, it's a big disabler of adoption. Ideally, you would want to be able to spend any stablecoin, not just a limited number of them, like with some providers out there. And yeah, last but not least, people want to get rewarded. So when we talk to our 6 million registered customers, we tell them, look, guys, you've been using the custodial card product for a while. It's convenient, it's fast, you can earn a yield, you can earn like cashback. There's a lot of different features, but and there's no reason not to trust us, right? We've been around for 10 years. We're a regulated business. We're direct member of Visa and MasterCard. So as many different achievements as one can have in this space. But if you value self-custody, if you're true to this philosophy of cryptocurrency, here's a self-custodial card. You can now spend it directly from your on-chain wallet. And people, a lot of them go, oh, self-custodial card, that's cool. How's it different from the normal one? Is it better cashback? And you're like, come on. That's not the idea, right? But so yeah, long story short, people still care about rewards much more than they care about self-custody, and we just have to accept it and live with it somehow. So how it works, quite different. So typically, if you are a very advanced Web3 user today, and you know what a wallet is, and you keep your funds in your self-custody wallet, you don't want to risk having it on a centralized exchange. So the journey from your self-custodial wallet to you buying a coffee or I don't know, Rakia here, you need to execute and sign transaction in your self-custodial wallet, send it to a centralized exchange, off-ramp into whatever local currency you're using, send it to your bank account. That's quite a friction point, and some of you probably know, because it can take time, it can cause fees, and it can cause questions from the bank, all the way to the account being restricted or blocked because not all the banks are still comfortable with cryptocurrency. And then you finally happily buying your coffee, right? In the current set, like what's possible now is you tap your card and funds go directly from your wallet, and the merchant receives their dollars, euros, dinars, whatever, and you made the payment. So all those extra steps are removed. How it works? Yeah, no, I think there's a bit of a misformatting here, but hopefully it should still be clear. So basically, within the decentralized app, user gets a smart contract wallet enabled by account abstraction technology. They connect their external wallet. They sign the transaction to give the smart contract the permission to spend with the card. So the tap or swipe of the card triggers that on-chain transaction, and funds go directly from the user's wallet into Visa network. And later on, there will be other, I think we already have SEPA as well, and we'll be adding additional real-world payment rails. The only thing that the user needs to do is bridge their assets from Ethereum to whatever fast enough L2 or another chain is to be used, because Ethereum is still nowhere near fast enough to match the speed of transaction of Visa and MasterCard networks. And this makes it fully self-custodial, because some cards are actually linked to non-custodial wallet. There's a 1inch card, there's a Coca card, there's a few others. They are linked to your non-custodial wallet, but it's not really like a truly self-custodial card, because to make funds spendable with that card, you need to convert it into fiat. You need to convert your crypto from self-custodial wallet into fiat, and the fiat on the card becomes e-money, and that's already regulated business, and that's already you trusting your money to someone. Whereas in this setup, there's no moment in time where Wirex or Gnosis Pay or other providers take custody of your funds. They go directly from your wallet and execute the payment. So this way, the problem of slow and costly off-ramps is solved by real-time card settlement globally. Custody risks are completely removed because there is no custody of funds.
3 more minutes.
Yeah, crypto can be used day to day. Who can benefit from this? Apart from, of course, the end users, wallets, any wallet can integrate this technology, and they don't have to be a regulated business, because providers like ourselves and some others will allow them to issue cards. Neobanks who want to go into crypto, and businesses can set up corporate cards accounts, manage their treasuries in a self-custodial manner, and still be able to pay their suppliers in euros or whatever currency they're using. A DAO can link such a card or set of cards to their treasury and allow contributors to pay for real-world expenses whilst managing the access and limits. And pretty much any developer can use the technology to add this functionality to their DApp. Like if you want to have a card in your on-chain game, it's fairly easy to do so now. So are we there yet for the on-chain payments in real world? Never been closer. Still need to work together on it. But yeah, I think 1-2 years from now, payments will become a lot smoother than they are. I won't pretend that I know what's going to happen in 3 to 5 years. Probably no one knows with the pace this industry is moving. But yeah, I think we're on the edge of probably not revolution, but very important evolution in real-world payments. And yeah, we're open for questions.
Microphone. Okay, let's give a big applause. We'll have time to squeeze one question, so please raise your hands if you have any. In the first row.
Thank you, Georgy. You mentioned there is no any point in time when the money is custodied by like your party or like intermediate banks. But how actually this conversion from like USDT to like Visa as a like the payment processor happening, like how from your layer 2 network money going through everything else to the traditional finance?
Well, with Visa, it's themselves, even now, when it's custodial setup, when we already have the user's balance, the actual settlement of the transaction with Visa, of course, doesn't happen for every transaction. We would settle with Visa at the end of the day for the whole amount of that has been transacted over the previous day or previous weekend or whatever. In case of this self-custodial product, not everyone is there yet, but Wirex, as an example, is part of, I think, 10 pilot use cases with Visa that are actually testing settlements in USDC. So I think on the acquiring side, quite a few providers already do this. I think Checkout.com and WorldPay, a few others, already allow merchants to settle in stablecoins, which shortens the settlement cycle, which is probably even more important than the fee that they pay. So I think at the moment, the fee they charge for settlement of stablecoins is actually higher than the settlement fee for traditional currencies, because it saves so much time. And especially for small, medium businesses, it's very important because it helps them not lock a substantial amount of their liquidity, like daily volume of their operational liquidity. And it happens instantly rather than taking a day or 2 days in case they're using SWIFT to settle. And yeah, so we almost don't care what currency is used. We could enable pretty much any currency to be used there, but we just see that USDC, USDT, and DAI would cover, at the moment, would cover 97, 99% of all cases, but going forward, we will be adding additional like Euro stablecoins and other regional stablecoins. So from your perspective as a user, it doesn't matter. So the exchange happens in the background. A lot of complex stuff happens in the background, but the main point for the user is we don't take custody. Well, we might be taking custody for like whatever number of milliseconds, right? But that's not really custody.
Thank you.
Okay, thank you. Let's give a big applause to Georgy.